How are family trust distributions taxed? Have you ever wondered how family trust distributions are taxed, especially for the rich and famous? This topic is essential for understanding wealth management and inheritance planning. Family trusts are often used by wealthy individuals to manage their assets and ensure a smooth transfer of wealth to the next generation. Let's break down how these distributions are taxed. First, it is important to know that family trusts are legal entities that hold assets for the benefit of selected family members or others. They can earn income from various sources, such as investments, royalties, or business interests. This income is subject to income tax. When a family trust distributes income to beneficiaries, the tax treatment varies based on whether the distribution is classified as income or principal. Distributions of income include dividends, interest, or rental income earned during the tax year. This income is generally taxable to the beneficiary who receives it. The beneficiary must report this income on their personal tax return and pay taxes at their individual income tax rates. This can be advantageous if the beneficiary is in a lower tax bracket than the trust itself, which often faces higher tax rates on undistributed income. On the other hand, distributions of principal are the original assets or capital gains realized by the trust. These distributions are typically not taxable to the beneficiary when received. The trust may have already paid capital gains tax on asset sales, making principal distributions generally tax-free at the time of distribution. Trustees have some flexibility in how they allocate distributions between income and principal. For example, a trustee can choose to allocate income distributions to beneficiaries in lower tax brackets, while others receive principal distributions that are not taxable. This strategy can help reduce the overall tax burden for the family. Additionally, trusts themselves pay income tax on any undistributed income, often at higher rates than individuals. Therefore, distributing income to beneficiaries can be a smart tax-saving strategy. For celebrities, family trusts also play a significant role in managing the taxation of intellectual property rights, royalties, and posthumous earnings. By placing these assets in a trust, the estate can avoid probate and potentially reduce estate taxes. The income generated and distributed to heirs is taxed as income, rather than subjecting the entire asset value to estate tax. In summary, for the rich and famous, income distributed from a family trust is taxed to the beneficiary at their personal income tax rate. Principal distributions are generally not taxed to beneficiaries. Trustees can strategically allocate distributions to minimize taxes for the family. Trusts pay tax on undistributed income at higher rates. Using trusts can protect celebrity estates from probate and reduce estate taxes, especially for intellectual property and ongoing earnings. Understanding these tax rules is essential for optimizing tax outcomes and preserving wealth across generations.